So, continuing on with the monetary policy, we're going to talk about how the change in money supply coordinates with money demand to form the money market. So the money market gives the relationship between the quantity of money demanded and the interest rate, little I, which you can also think of as the price of money. It shows the public's preference for liquidity changes as the interest rate changes. So just to put this in different terms, if you had a savings account that paid you 1%, you're not very motivated to put your money in that bank. But if the interest rate goes up to 10%, then you and everyone else would be really racing to the bank to put all your money there. So the interest rate affects your desire for liquidity. If it's 1%, you're going to go, that's not even worth my time. I may as well just keep it in my pocket. But if it's 10%, you're going to go, no, I want to make that 10%. And I'm willing to put my money in the bank and let them hang on to it until, I need it. So here we have the money market equation, where here we have the price of money, which is the interest rate, I, and here we have quantity of money, which is the M1 balance, the demand for money. So as the interest rate goes up, that leads to an increased opportunity cost of holding cash, and the quantity demanded of money will go down, ceteris paribus, all other things remaining equal. So we're going to simplify, and we're going to assume that the Fed can fix the quantity supplied of money at a specific amount. So another example of how in economics we make certain assumptions so that we can build a model to prove a point or disprove a point. So here we have the money supply, and we said that it's going to fix the money supply at a constant point, which is why it is vertical like this. So this is saying no matter what the interest rate is, the supply of money in this example is remaining the same. So here we have the demand for money, which is a downward sloping, which implies that as the price goes down, the quantity demanded goes up. So we've got the interest rate here. So for example, if the interest rate is way up here, the quantity demanded of money is lower, meaning that I don't want the money in my pocket. I'm going to put it in the bank. As the interest rate drops, you can see that the quantity demanded of money goes up and up. Right here is the equilibrium point. So this would be the equilibrium demand of money. At equilibrium, so we say here, if we go back at I1, the quantity demanded is less than the quantity supplied. We've got this gap right here, and there's a surplus of cash balances. The excess cash will go into other assets, and the interest rate will drop. Will drop, wanting to reach equilibrium. At interest rate 2, the quantity demanded is greater than the quantity supplied. There's a shortage of cash balance. The shortage will cause interest rates to go up to get to equilibrium. So when we talk about cash, there's nothing magical about cash. It simply is another commodity, just like a pair of jeans or just like a car. There's a quantity demanded and a quantity supplied of this product. So the Keynesian monetary theory says that they go through the Keynesian monetary transmission mechanism, how a change in the money supply works its way through the economy. So the short-run monetary target says that interest rates affect aggregate demand, as the change in the money supply leads to a change in the interest rate, which leads to a change in investments, which leads to a change in aggregate demand. So if we're trying to expand the economy in a Keynesian view, we're going to say that an increase in the money supply leads to a decrease in the interest rate, which leads to an increase in business investment, which leads to an increase in aggregate demand. Whereas a contractionary monetary supply in the Keynesian view means a decrease in the money supply will lead to an increase in the interest rate, which will lead to a decrease in business spending, which will lead to a decrease in aggregate demand. And in the Keynesian view, Expansionary monetary policy will be ineffective if there is a liquidity trap. So a liquidity trap is this horizontal portion of the money demand curve. At this point, even if you increase the money supply, so you see the money supply here, and then the money supply is increased, it doesn't lead to any change in interest rate. If there's no change in interest rate, then there's no change in business spending, and there's no change in aggregate demand. So you don't want to be in a liquidity trap, which is basically when the interest rate is so low and everything is stagnant that the government can't do anything. So in this case, expansionary policy would be completely ineffective. Why would this be? Investment and consumer spending are insensitive to the change in the interest rate or are pessimistic about the future. So in a Keynesian view, the policy recommendations would be in a recessionary gap. Keynes argued in favor of expansionary fiscal policy for curing recession, in particular, an increase in government spending. It is worth noting that Keynes' view was that the government should only do this to kickstart a recession, and then the government was supposed to back off. But if you look at the past 50, 60, 70 years, the government has never backed off. Once they start spending money on something, they don't ever stop. So that is a big problem. Again, though, with the Keynesian policy, an inflationary gap during an inflationary expansion, contractionary monetary policy will be effective at closing an inflationary gap. And then there's the monetarist model. This is very, very simplified. This is the quantity theory of money, the equation of exchange, where the money supply times the velocity of money, or how often the money changes hands, how often it moves through the economy, is equal to the price level times real output. And the price level times real output is nominal GDP, right? So MV equals PQ. If you know the nominal GDP and you know either the money supply or the velocity, then you can solve for one of the unknowns. So example, if we know that the velocity of money is 4, the price level is 2, and the real output is 10, then we solve for M and we get that the money supply is at 5. So just a couple more little tidbits. How can you figure out what the real interest rate is? The real interest rate is the nominal interest rate minus the expected inflation rate. For example, if the nominal or stated rate is 8% and inflation is 3%, then we know that the real interest rate is 5%. Why is this important? This is important if you're going to make an investment or you're going to take out a loan and you're talking about interest rates in the future. And finally, if the government wants to keep inflation low, the goal should be to set money growth equal to the expected percentage change in real GDP so that everything moves up at that around 3% level. And that is it.